of all, let me thank you for coming here today, and Olatz and Luis Buceta for organizing the event. Also, I am very pleased to welcome the members from CFA Society Chile for joining us in this event, the first of many we will do together, I hope. I really wish you will find the webinar interesting. First, I'd like to introduce today's presenter. We have a really special guest today. Adam Mead is CEO and Chief Investment Officer of Mead Capital Management, a value-focused New Hampshire-based registered investment advisor founded in 2014. Adam published a few months ago a new book on Berkshire Hathaway with the title The Complete Financial History of Berkshire Hathaway, a chronological analysis of Warren Buffett and Charlie Munger's conglomerate masterpiece. A truly titanic endeavor, I must say, and the result of many years of careful research and countless hours studying Berkshire's materials. Today, we are going to have the opportunity to review the book with Adam, covering the main milestones in Berkshire's history, its main acquisitions, its valuation framework, what makes Berkshire's insurance operation so special, and countless other topics. For those of you interested in diving deeper into these topics, Adam has set up a webpage called theoracleclassroom.com, where you will find, among other things, the tables and graphs that populate the book in a spreadsheet format. The event will be structured as a 45-minute Q&A session, and after that, I will open the floor to questions from the audience. And without further ado, let's say welcome to Adam. Hi, Adam.
Thank you. It's really, really great to be here. Thank you so much for inviting me.
Well, first of all, starting with the questions, what is the main lesson you have extracted after writing the book? In one simple sentence.
Yeah, geez. That's a tough one. I'll pull back just a little bit and just say that I think one of the main lessons, just as I've studied Berkshire, the more and more I study it, just how lucky I was and we are to have Warren Buffett and Charlie Munger as teachers, and just to have them. I mean, they have drastically improved my life. I'm sure many of the lives here, and just the impact that they've had opening up their book and showing us basically the truth. That's just a very, very broad lesson. But just to kind of get a little bit more specific into Berkshire, I guess I'd say, you know, when you look across Berkshire Hathaway's operations, it really spans every aspect of the economy, right? And so I guess the main lesson is that anyone can do well in just about any industry or sector. It really, management is so key, and finding these niches within industries. You know, it's not like it's just one thing. It wasn't like Berkshire Hathaway was just insurance. You look at the success stories across Berkshire Hathaway, and among every single industry, Berkshire owns all of these gems, and it's really special. So a little bit longer than one sentence, but.
Well, starting from the beginning, and there are a couple of fascinating chapters dealing with Berkshire's history pre-Buffett years. Could you talk a little bit about these years, which are probably not well known for our audience?
Sure. So I'll just briefly, very briefly, and so when I sent Warren the first couple of chapters, the idea was to start at 1955, which was 10 years before Buffett came on the scene. And when I sent him the first couple chapters, he actually suggested going back to the pre-World War II days. And since I was going back that far, I said, well, I'm going to go all the way back to the very beginning. And so, you know, just a one sentence on Berkshire's very early history, the whaling business in New England in the 1800s declined. It created a lot of rich capitalists in New England. When that industry declined because of the Rockefeller and those guys finding oil, that capital needed somewhere to go, and into textiles it went. And so that created this boom in textiles. And then, of course, Berkshire 2.0 was going from textiles to these better businesses. But that couldn't have happened with Berkshire's existing management. So I'm referring to, Seabury Stanton, the former president that Buffett took over from. Now, it's really interesting. So this 1930s period, you saw a struggling industry. You saw a lot of textile businesses go out of business. It was industry consolidation. So, this is a familiar sort of playbook, if you will, which is why it's so interesting to study. But the industry consolidated, and then World War II hit, and that caused this spike in demand and this huge boom, which left the few firms that were remaining with this huge opportunity. They had incredible profits. And then after this temporary spike happened, it literally went south to the American South, where during the 1950s, the textiles continued to struggle. And then, of course, overseas competition continued to erode the industry. But what's really interesting about this period, when we think of the pre-Berkshire or pre-Buffett days of Berkshire. So in the 1950s, we think about it as, a bad business, which it was. But Berkshire's management actually acted pretty rationally during that time. They shrunk the business. They did something pretty unusual, which was to sell off plants, pay out dividends, and actually buy back shares. They shrunk their capital just about in half. This, of course, attracted the attention of Warren Buffett. He tried to tender his shares. Seabury Stanton wouldn't do it. And that ultimately led him to seeking control of Berkshire. But it's interesting to see this arc of history in the pre-Berkshire days, which I think kind of like, I'm sure this group is familiar with security analysis, Ben Graham. The examples are old, but the lessons are timeless. And so I think that period of Berkshire's history is certainly worth studying across the board for any student of business.
And then in 1965, Buffett took control of Berkshire, right? And just after that, one of the first few acquisitions was National Indemnity. You say that this company was probably the most consequential acquisition in the history of Berkshire. Could you give us some perspective about its historical importance?
Yeah, so National Indemnity, I mentioned in the book how insurance really was this rocket fuel that just accelerated Berkshire's development. You have this you have this wonderful world-class capital allocator, and then you give him more capital to generate. And so National Indemnity, NICO, it was really instrumental, not only for what it was, but what it taught Buffett. And so it was a great business. It had superior economics to textiles. And it taught Buffett that in insurance, it was the lesson that pricing of risk was more important than the type of risk. So Jack Ringwalt who built the business, he would literally insure lion tamers and things like that. I mean, he would take almost any risk. But as long as that risk was appropriately priced, he was willing to take it on. So it really taught Buffett that aspect of it. But then it just really supercharged his interest in insurance. Berkshire started all of these home state companies, but struggled along the way. But it was really this entry into insurance. And when you look back at that acquisition, Berkshire really underpaid. I mean, they paid $8.6 million for this business, which is almost $2 million over book value. But it had $19 million worth of float, which was money that Buffett could then turn around and use his investing skills to continue to multiply. So it really provided quite a catalyst to Berkshire at that time. And as we know, today Berkshire is one of the largest, if not the largest, insurer in the world, certainly in terms of capital. And National Indemnity is still there today in Omaha.
You mentioned the importance of float in this acquisition, and there is a very interesting section in the book Well, it's much after that, in 1995, in which you discuss whether insurance float is better than equity or not. I mean, could you walk us through your thoughts on that? Because I think it's a crucial topic in order to understand Berkshire.
Yeah, thank you. It's a great question. I'm glad you picked it up, and I'm really happy to have this group to really sort of geek out on this, because it is somewhat of a counterintuitive and maybe even I guess advanced sort of concept. But Buffett in 1995 made the comment something along the lines of Berkshire had then had about $7 billion worth of float. And he posed this example, this hypothetical example. Would I trade Berkshire's $7 billion worth of float, which is a liability, for the equivalent of $7 billion worth of equity, tax-free, just magic overnight? And he said no. He said he wouldn't do it. And it really, I mean, I think I say in the book, it should make you sit on the edge of your seat, because what he was saying was, here is this source of capital that is long-lived. It can stick around for a while. It can grow. And oh, by the way, it does not dilute equity or come with the risks associated with borrowing. And it really struck me as something quite incredible, the way to think about that. And if you go back and read Charlie Munger's Wesco letters to shareholders, you'll hear him talk about basically valuing Wesco using book value plus deferred taxes, and you can do that with, I think that's how he valued Berkshire as well, deferred taxes plus float. And if you listen to Buffett talk throughout the years, he makes reference to the change in float almost as if it were net income. He said, we have this capital come into Berkshire, and but the key here, the key to this is if that float is appropriately priced. So it needs to be, in Berkshire's case, over time, they've had cost-free float. So they've essentially borrowed money for 0% or even negative. They've been paid to do it. But as long as that float on average does not cost more than the long-term government bond, it's actually an incredible source of capital. And I model out, even I think later in the book, a hypothetical decline in float in conjunction with a slight underwriting profit. And even under that scenario, float is essentially replaced by underwriting profits, and it leaves a permanent source of capital. So the way Berkshire has structured its float is such that it is essentially equivalent, if not better, than equity. And it's somewhat counterintuitive, but it's really incredible.
Now, this is certainly interesting, and it's very counterintuitive, as you said. In any case, what has made Berkshire's insurance so special? I mean, there have been many intelligent investors in the past, like David Einhorn, Tom Gaynor, Prem Watsa, that have tried to emulate this kind of flywheel, right? But to no avail. Is it operations, jurisdiction because of taxes and regulations, concentration of the equity portfolio, or what else?
Yeah, and I guess I wouldn't totally dismiss those as they haven't been able to grow to the size and extent of Berkshire, and maybe they're not as good, but they are still very good operations. Those ones that you mentioned. But I guess and I'll just say this as this part of this question. Luck played a role. I mean, let's not put it all on the genius of Warren Buffett and Charlie Munger and Ajit Jain. Buffett, 1967, even before that, I mean, with Geico, studying Geico in his early years, he had luck on his side. He was there first, right? I mean, he was able to get Berkshire's operations going first. He was able to learn these mistakes of what not to do. And he either created insurers to fill these niches or purchased them. But then beyond that, I think the key really is discipline. So it's the ability and the willingness. You need both of those things to do nothing for long periods of time. So there was this 13-year dry spell at National Indemnity between 1986 and 1999. National Indemnity's written premiums went from something like 365 million down to about 55 million. Now, every single one of those years, they wrote to an underwriting profit. So the ability to essentially not care, and the willingness and the ability to sit there and not care if your written premiums shrink is really an incredible discipline that I think some other operations might last, because it's so easy, as Buffett talks about, to just write a policy and have cash come in, because that float is so tempting to just reach out and grab. But if the pricing discipline is not there, you end up with underwriting losses in the future. And so I think it was a combination of luck, this discipline, and then of course Buffett's genius at figuring out, really exactly what works, and incentivizing its employees appropriately too. I mean, that's a big part of it as well, where these managers and employees were not incented to go out and write business; they were incented to make a profit, and that really, I think, was the capstone there.
Yes, we are going to discuss the compensation and the manager's compensation of Berkshire later on, but finishing with the subject of insurance, I mean, inflation nowadays is a hot topic. And curiously enough, one of the, I may have read the book wrongly, but one of the important topics throughout the book is the topic of inflation, right? Inflation was historically high in the 60s and 70s. Might that have been the cause of poor underwriting results back then, because float was so valuable, so it attracted a lot of competition, but which were more than compensated by excellent investment results? I mean, what I'm trying to say is that it seems that there has to be some relationship between inflation, underwriting, and float. And as even Buffett himself said in 2016, the value of float nowadays is less than in the past because of lower interest rates.
Yeah, I'm trying to think about that. So I'm not sure, and it would be a very good question for Buffett. I'm not sure if inflation caused, just so inflation was generally at that time a lagging effect. So and there was two types of inflation that Berkshire experienced. There was the general economic inflation of the price, the general price level going up. And then there's this other aspect of social or judicial inflation, where a jury or judge would effectively retroactively provide additional coverage to the insured. So you not only had to look out when you were writing a policy as to what your costs, say, of repairing an automobile, a building, or a human, right? What those medical costs would be, but also whether a judge or jury would award more than was actually in your contract. But that was a lagging effect. And so I'm not sure if it was, if it was just, I mean, inflation certainly hurt them. And that was, again, the discipline to walk away when pricing was pretty loose. So you had a cost pressure that was lagging your premiums, and then when times got better, it was so easy just to cut rates. So competition, we saw this. There was this sort of slow bettering, if you will, of the environment, and then it's so easy for capital just to flood in and cause rates to go back down. So I'm not sure if I completely answered your question there, but Berkshire, if you look at some of the tables I have in the book, there was only a handful of years that they had an underwriting loss, for one, and two, those losses were generally not that much worse than, say, the government bond. So even with a cost of float, they still had a source of capital that was basically equivalent to a government borrowing rate, which is pretty incredible when you think about it.
Okay, thank you. No, I know it's a tough question to answer, but well, now let's go to Berkshire's investment, which is probably a topic that is quite famous. I mean, in your section reviewing the first 50 years of Berkshire, there are a couple of very interesting summary tables on the main capital allocation decisions per decade and the distribution of the expected return for the main investments. I am going to share now these graphs, but could you summarize what are, in your view, the main milestones in these graphs, so to speak? Let me see. Can you see it, right?
Yes. So this was a table I put together in the chapter covering Berkshire's first 50 years. So these are the decades that ended these years. And the book, just for those who haven't read it, the origin is 1965 when Warren Buffett took over as chairman and CEO. And so the chapters are structured covering 10 years, starting at the five, so 65 to 74, 75 to 84, and so on. So at the top of this chart, just of interest to folks, just strictly in common stock investing, Berkshire's largest single common stock as a percentage of the portfolio was pretty consistently at almost a quarter of their portfolio over those decades. Same with the top four common stock investments, and as in terms of the percentage of the portfolio, as well as a percentage of average equity. But just I guess to move to the main sort of meat here in the second section, the acquisitions as a percentage of average equity capital. The one general theme I saw when I looked at this was Berkshire Hathaway has continually made very big bets over its history. So as a percentage of its equity capital, the first one there, the Illinois National Bank and Trust, interestingly, was the largest at 44%. But right about, if you look at the next decades, 15 to 20% of Berkshire's equity. So as Berkshire grew, it just continued with this concentration, not only in the common stock portfolio, but in wholly owned businesses. And so you see the bank, which they bought in 1969, they had to divest that by the end of 1980, which is why it disappeared. But it really gave Buffett a great insight into banking. If you look at the 84 decade, the largest there was the Buffalo News, which at that time, newspapers were what Buffett called a franchise business, just a really wonderful business. They had great economics. You almost, it's, I guess, a pun, but, they printed money because they just had such a lock, especially these one newspaper towns like Buffalo. The 1994 decade, we see Scott Fetzer there at a 19% of Berkshire's average equity. Again, another huge acquisition. I think it was about a $700 million revenue business at the time, but that was a little mini conglomerate that Berkshire picked up in the mid 80s. It came with World Book. It came with Kirby. Those were the two main divisions at the time. Kirby has recently been sold, actually. And then, you get into the 2004 decade and we see this pivot into insurance in a very big way with the acquisition of General Re. That one, that was actually an all stock deal, which is another really interesting part of Berkshire's history, this sort of great second pivot, as Chris Bloomstrand likes to say. And then we see in the 2014 decade, BNSF, which is the railroad that they purchased in 2010, which was 18% of the equity capital, cash and stock deal. That one, that reflected Berkshire's evolution towards a more capital intensive type of business. And even preceding that, about 10 years earlier, they got into the energy business. So what we saw was, again, a continual, Berkshire grew, it never paid a dividend, and it at very, very few instances actually repurchased shares up until recently. A series of larger and larger investments, which actually speaks, the big question mark is, what will the 2024 column read, right? I mean, for Berkshire Hathaway, which today has equity capital of, pushing $500 billion, at 15%, that's a $75 billion acquisition. And so the question mark is still out there. Will Berkshire be able to do it? And we'll just have to wait and see on that one.
We have the same information of the major acquisitions, but now in terms of returns, right?
Yeah. So what I was trying to do with this chart here was just to illustrate this dynamic that you have a business itself, like Charlie Munger talks about with the pari-mutuel system of horse betting. You have the horse, which is the company, and if it's a really good business, you have to pay up for that business, and that process of paying up brings down your initial return. But what we saw, just looking at this chart, some of these businesses, just starting at the left, were businesses that had a pretty good, call it mid-teens returns on capital. The purchase multiple was in some cases around book value, but in other cases a little bit higher. And of course, as time went on and markets got more efficient, those purchase multiples went up. Then you look at the extreme other end. So I'm looking at the right-hand side of this chart. The earlier acquisitions, Seas and Fecha, down at the bottom there, wonderful, wonderful businesses earning incredible returns on capital. They were able to buy those at a pretty cheap multiple, as judging by the quality of the business. Fast forward a few decades to Lubrizol and Heinz, and you have Berkshire. You see Berkshire's willingness to pay up for better businesses, and so Lubrizol and Heinz, again, great businesses, but they paid quite a hefty multiple for that. And I have another chart in the book too that sort of adjusts it for going in returns. But I think this sort of two-axis approach of looking at them shows the evolution of Berkshire over time, and even the evolution of their thought.
Yes, it's this. I found this graph very interesting because it summarizes very clearly the evolution of Berkshire in paying up, as you said. Well, throughout the book, you explain in a very coherent fashion Berkshire's main investments through the lens of the return on capital employed by the businesses, as we have just seen in this graph. Could you share a few thoughts about Buffett's investment process and how this method, so different from Wall Street's, ties to his main investment principles?
Yeah, so I'll admit a mistake. I consider it a mistake. It's not a huge one, but I guess I think I erred slightly in using. We're all analysts here in this group, and so how do you calculate return on invested capital? In the book, I used the right-hand side of the balance sheet. I did an equity plus debt, basically, sometimes deferred taxes. But that was my approach. I should have started with the asset side of the calculation. It's minor, but it just kind of, it's more of a technicality, I guess, in hindsight. But the basic message is the same. I saw Buffett describe the textile business through the lens, I guess you'd call it, of capital employed and margins. And so it just sort of hit me that this is the way he sort of normalizes looking at every single business. So, step one, how much capital am I putting out there? What are the margins? And then the third sort of element here is, through the lens of economics, how might those things change over time? So will the capital requirements of the business change because of competition? Will margins change because of competition? And you start to see sort of the sensitivity of that. But it's almost a way of, Buffett doesn't use a single, he doesn't use the traditional sort of Wall Street approach of, looking at a cost of capital and then adjusting for risk. He generally uses this sort of blanket single return, looks at opportunity cost, and uses a margin of safety. Well, in the same way, looking at a business as if it were completely equity financed, which is how Berkshire purchases businesses, even if they have debt, this framework sort of unites all businesses and lets you compare them. And some businesses are good businesses that use a lot of capital, but they're still good businesses. Others use very little capital, but have great returns, but can't reinvest. But it's sort of a way of a framework of basically uniting all of the opportunities that are available to Berkshire at any time.
Yes, as you mentioned, you have businesses with I mean, that they are capital light, like Seas Candies, and other ones that they are heavy ones, like Flight Safety. I mean, Flight Safety, I think it's a very interesting acquisition because it was done in 1996, and I think it moves Berkshire towards this kind of capital-intensive businesses, but with long-run runways, right? Could you explain both Seas Candies and Flight Safety from the lens of the return on capital employed framework discussed previously?
Yeah, absolutely. So, so Flight Safety. So we'll start with Seas Candy, and I don't want to presume that everyone in this virtual room knows Seas Candy, but Seas is a very famous, I guess, case study, and Berkshire still owns it today. Purchased in 1972, wonderful business, generates very, very good returns on capital, but it can't. It doesn't. They tried, but they cannot really grow the business to any extent in terms of unit volume. Flight Safety, again, as you noted, a very interesting acquisition. Really, one of the first more capital-intensive businesses, and I think so. Flight Safety, they train pilots. They have flight simulators, and they train pilots, and it's a very capital-intensive business. And so the example that I picked Seas and Flight Safety to compare because I looked at it first from the lens of operating margins. And so I said, Flight Safety has this operating margin of 29%. Seas Candy has an operating margin of 21%. Well, what's the better business? The answer is Seas, but the sort of dynamic here of Flight Safety generated, I've got it right here, revenues to assets of just 24 cents, 0.24. Seas Candy, by contrast, 3 times revenues to capital. And so, and I'm using assets because the data wasn't available in the Berkshire report, but the comparison still holds. So just on a return on assets basis, Flight Safety was generating 7%, and Seas Candy was generating 65%. So you have this framework, and I see it, and you might too, whether it's in the business press or other analysts talking about, well, geez, look at this business that it's terrible, it has low margins, or it's great, it has high margins. But Buffett's framework of sort of just saying, well, forget about that. What really matters is return on capital. And so Flight Safety was a business that employed a ton of capital, but it had barriers to entry because of that, which created a moat around it. But it also had the ability to grow. And so unlike Seas, which had to distribute all of its cash because it couldn't do anything with it, it gave it to Buffett. Flight Safety could spend another $20 million on a flight simulator and grow that business. So it's, again, as we look across, it's, as we're all familiar in this room, it's all about trade-offs, right? There's always trade-offs.
One of the most fascinating and recurring themes throughout the book is how Berkshire has a structure, managers' compensation, and in general incentives, right? Munger always says that, show me the incentives and I will show you the outcome. So, I mean, for instance, not writing insurance policies if the price is wrong, Todd Com and Ted Wessler bonus structure, etc. Is there any overarching lesson here for all of us?
Yeah, this is a really fascinating topic, and one that I actually asked Warren it was the very last question. I want to say it was the 2018 annual meeting, but as I've gone through and as part of the book, I listened to and read all of the annual meetings, and I saw this question come up again and again in some different ways. Buffett has said that they're pretty simple. Once they're in place, they don't have to really be changed. But I think what really unites them again is Buffett's thinking about the economics of the business, and then also incentives. So with insurance, at Geico, for example, they're incented on new policyholder growth and the profitability of year two business, because year one business can be expensive. So that's just one example using Geico, but Buffett has said that it's all about the economics. So, a flight safety, for example, they might incent them to use less capital, because capital is a very important part of that business. So if that business is able to do the same amount of business with less capital, that's just as important, because if they can return capital to headquarters while doing the same amount of business, that's something that's very attractive to the owner of that asset, which is Berkshire Hathaway. So I think I've spent a lot of time thinking about this, and I think it really comes down to the economics and the incentives. But it sort of helps to work through some of these scenarios. And literally, I actually have just a little plug for my YouTube channel, The Oracle's Classroom. I'm sure we could put a link to this, but I have a whole playlist on some of the comments that Buffett has made on compensation arrangements. But just literally 2 days ago, I had someone ask me the question. They said, well, geez, if someone's incented to send cash back to Omaha, couldn't they just let the business decline and essentially send the cash back? And I had to think about it for a minute, but they're generally, as I found with Buffett, studying Buffett, things are generally pretty simple with him. And but that doesn't mean he hasn't thought about it a lot. So that's kind of a long-winded answer to that question. But
I found your final chapter very interesting, and it's a different one from the rest of the chapters, so to speak, because it's not a chronological analysis, but rather a general discussion where you discuss why Berkshire is probably the greatest conglomerate of all time. What are the main differences of Berkshire versus the conglomerates of, say, 3 decades ago?
Yeah, Berkshire is again so fascinating because, as I say in that chapter, luck really did play a part in Berkshire's success, and so it started sort of in this sweet spot of during the 1960s and even a little bit before. There was this conglomerate boom, the go-go years of the 1960s, which featured a whole bunch of different conglomerates. But Berkshire was able to extract the lessons of those early conglomerate failures, and a lot of them were failures, not just the businesses, but in their results on shareholders and investors. So he was able to take those early lessons and apply them in a market that was still inefficient, right? So the 1960s, the 1970s looked nothing like they did today. There was still a huge amount of opportunities around. But those 1960s conglomerates like LTV, which is Ling Temco Vought, ITT, Textron, some of these early ones, a lot of them were based on either issuing shares and sort of doing some of this accounting trickery, and they were not sustainable. And when you hear specifically Charlie Munger talking about some of these, it's that whole adage of taking the high road, and Berkshire Hathaway really is structured in such a way that it really is a masterpiece. It really is a museum piece, and it was built to last. And these early conglomerates were not. But again, I just have to throw out, and I don't think Buffett would disagree with me, that luck played a huge part in the ability of Berkshire Hathaway to get to where it was today.
And one final question from my side, Adam. What should we expect from Berkshire going forward?
I'm sorry, what was the last?
what should we expect for Berkshire now going forward?
Yeah, Berkshire of tomorrow. I think it'll look pretty much, well, I wouldn't say pretty much the way it is today, but if you look again, you sort of saw, or we're starting to see this sort of third phase, if you will, of Berkshire now returning capital to shareholders. So if you're a Berkshire shareholder, which I am, we've been very lucky in the fact that Berkshire's share price has stayed pretty low over the past couple of years. That this has allowed Berkshire Hathaway to return capital to shareholders in the form of buybacks, which are not only tax efficient, but because of the price that they're paying, very accretive to existing shareholders. So I think in the future you will see a lot of the same. You'll still have the Berkshire Hathaway sort of magic, if you will, of being patient, of being disciplined, of waiting for the right pitch, whether it's an insurance contract or an acquisition. But I think you will see a greater return of capital going forward. And a lot has been made of Berkshire's cash position right now, which is right around $150 billion, to use round numbers. Well, if you look back on Berkshire's history as a percentage of total assets, it's really not that far out of line. So Berkshire may not get as big as it would have if it retained all of its capital, but I think Berkshire is still a very, very good business. And it really is the Rock of Gibraltar, which I say in the book, and of course is a wonderful national treasure for you guys. But no, this has been a lot of fun. I'd love to answer any other questions that this group has.
Okay, this has been great, Adam. So now I open the floor for questions. I mean, don't be shy. Adam will give his best shot to your questions. So feel free to ask anything you want.
Just don't make them too tough. I'm just kidding.
Javier, if you let me, I will be first.
Perfect.
Adam, thanks very much for your explanations and all the content. All very nice. I actually have two questions. The first one is related to a recent paper that I think that the guys at AQR published, the famous Buffett's Alpha. In the paper, they just say, look, everything that Buffett did was, using leverage, 1.6 leverage and actually focusing on very low beta type stocks, right? I mean, low beta stocks, we all know it gives a much higher return than what, the models would have predicted. So, it's essentially bought this low risk stocks, use leverage, and over 40 years, there you go. Berkshire Hathaway is nothing more than that. So this is, of course, that, running a regression that finds that sort of, conclusion is, it's very cool. But you have looked at the whole history of that. You spend 700, 800 pages writing the book. I wanted to know, what do you think about that? If it has to you any real, meaning, other than maybe it's just like, correlation and it's not causation, and, it's actually, a paper that probably doesn't say much. And my second question is related to, Berkshire's mistakes. That is to say, mistakes to this point, right? Things like profit highs, precision cost cards, and other, little mistakes that they committed over their investment lifetime. If you find an overarching explanation or one theme that they constantly get wrong, I don't know, maybe overpaying for a good business, or just if something pops to your mind. Thank you.
Sure. No, thank you. Great questions. The AQR paper, it's been a couple of years since I've read it, but the gist of it is just as you described, if my memory serves. I would say I would not argue that they are wrong. but I would push back. And the question that came to mind when I read that was, okay, well, how do you do that? How would if I, or you or I wanted to implement this strategy of just buying low beta stocks and leveraging up, we couldn't do it, right? I mean, you and I just can't magically access a source of leverage that is not tied to our risk, right? So, I mean, if we went to a bank or an equity supplier, I mean, there would be a cost of that capital. I think what was missed in that paper was the fact that the source of that leverage came from this incredible insurance operation that they built. And, yes, it's true that over the years, Berkshire's float has had a negative cost, but as one of the questions earlier alluded to, it's well known, but not very easy to actually create that. I mean, right? Markel has tried it. Fairfax and many other people have tried to create that source of leverage. So if it could just be done by virtue of a formula, I think everyone would do it. So that the key, I think, is just finding that key source of that low cost leverage. And Buffett has talked about on the asset side finding low risk investments in terms of I guess time arbitrage. The risk vastly diminishes over time as you hold these good businesses. But also, what's the famous, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So they have been very risk averse, I guess, from that standpoint, but also not shy about making, I guess, probabilistic bets when they come up, which kind of leads to your second question of mistakes. A common thread, I don't know if there is a common thread. I guess you could charge them with not being as studious of the mistakes of omission, right? Of missing maybe Walmart earlier. Or investing in Google when they saw how Geico, how much Geico was spending on Google. But US Air, I think I was a little dismayed when I saw them make the second round of airline investments a couple of years ago. Berkshire owned, Buffett even went so far as to say, if I ever start talking about buying airlines again, someone come talk to me. And but he went and did it. But it was sort of the same playbook of the railroads, where he saw this consolidation, but it just didn't work. So I don't know if it was a mistake. You mentioned Kraft Heinz. I guess Kraft Heinz and Precision Castparts. Kraft Heinz, and Buffett has talked about this a couple of times in an interview. It's still a wonderful business, and they didn't overpay for Heinz. They really overpaid for Kraft, and so they kind of misjudged the bargaining power, if you will, and the strength of private label brands like Kirkland at Costco and so forth. But luckily, it's another lesson there, I guess, which is they made a mistake. You can call it a mistake at Kraft Heinz, but if you go back and look at how much they paid for that, it hasn't been a loss of capital. It's only the mistake has been a lower return than they were expecting. But an actual loss of capital hasn't occurred too many times in Berkshire's history. The biggest of which was Dexter Shoe, which basically went bust.
We have another question from the audience, Adam, that, you can read it in the chat, but basically says that we are moving towards a world that it's more focused on technology, more asset light, and away from asset heavy companies. How do you think Berkshire will adjust?
Well, I think they already are. You've seen Todd Combs and Ted Weschler, but I suspect it's Todd. They made the Stone Co. investment. They've made some of these, even buying an IPO. I mean, how incredible is that to see Berkshire buy an IPO? I think the evolution of having this next generation of managers will drift in that direction. But I mean, they have done very, very well over time buying these essential businesses. I mean, when you think about the railroad, how incredible of an acquisition that was in hindsight. When you think about in the book in the early 2000s, I talk about this slate of non-technology businesses that were purchased, and I'm thinking of Acme Brick, Shock Harpet, some of these businesses that they're not really super exciting, but the cash generating ability of these businesses are incredible. And I think the biggest thing to sort of reference, go back to the question that was just answered, is avoiding the mistakes. And what's really interesting, just sort of a little bit of an aside, I think about Apple, Berkshire's investment in Apple. When you have a company that is so good, like an Apple, with an exponential compounding rate, you can be late to the party and still do very well. You don't have to get them early. You can wait until you see the effects of competition and whether they have staying power and whether there'll be regulations that crop up, and still do very well over time. So it's really a call to continue learning. But I would suspect in the United States, we're seeing in the utility business, Berkshire Hathaway is incredibly well positioned to benefit from the boom that is coming in energy infrastructure. I mean, this electrification for electric cars and repurposing the grid in the United States is going to be an incredible boom to Berkshire Hathaway. And so Warren Buffett really thinks in decades or longer. And I think before long, we'll see some of these seemingly boring acquisitions, unexciting acquisitions, actually become, sort of in hindsight, like BNSF, sort of a brilliant move. I hope that answers the question.
Yes, that was very complete. Anyone else? Okay, I think this is it. Adam, from the audience, well, thank you very much for this very interesting webinar. Thank you very much for your time. I think it was very deep. I recommend everyone to buy your book, which I read this summer, and it's I have to say it's a masterpiece. And you also have a YouTube channel, right, where you share many clips?
I do, yeah. And if anybody has a question after this, usually you hang up and say, "Oh, geez, I had thought of this." But at any time, I mean, please email me or reach out. I love talking about Berkshire. I mean, I'm still very much a student of the business. I still learn things, and I really enjoy the questions. Really get me thinking about Berkshire in different ways, and I continue to learn too. So by all means, and yeah, I have. If you go to theoraclesclassroom.com, you'll see some links, and we'll get you over to my YouTube channel as well. I'm kind of cutting up some of the Berkshire annual meeting clips and curating some content, and it's just a lot of fun. There's so much I've found going through Berkshire's history, sort of again and again, where you say, geez, that's relevant to today. And so I think I'm biased, but I think it's a business that investors should continue to study throughout their careers.
I fully agree with you. So anyway, thank you very much for your time, and thank you very much everyone for coming today. I hope you found it interesting, and have a good evening.
This is a lot of fun. Thank you so much.
Bye.